surge inside of the equity markets goes on. What am I talking about? That is the S&Ps, the Nasdaq, the Russell, all trading to the upside throughout the course of this week. Now, in this video portion, there are four major ideas I want to get across before we jump into some charts, some option chains, and absolutely we're going to talk about some very specific trade opportunities. Point one to be made here is, as I was saying, the surge goes on. Now, no news, no data, put it all aside for just a second, okay? The S&Ps are just getting wild, if you will, to the upside. And I say that simply because we're only 2 weeks removed from a yield curve inversion. Now, for those of you that are a little newer and don't necessarily know what a yield curve inversion typically signals, well, in every past occurrence of a yield curve inversion, what do you have? Okay, a few months, maybe a year afterwards, happens to be a recession. You see a new recession in sight, you get this massive disconnecting feeling right now between what the bond markets and yields are saying and what the equity market is saying. Who's going to be right? It's just like the wild game of chicken. I'll show you in the charts here in just a couple of moments. So that's effectively point number one, is again this disconnect between, again, the yield curve inversion and the equity markets. Point number two to be made has everything to do with the SPX. Now I'm just going to geek out on you for a second. This past week, we were looking for about a $37 expected move. That is, the options market was depicting about $37 of movement higher or lower. Well, we actually surged not only the $37, but we added another 20 points to it additionally. So we smoked through the expected move. And what happens to the implied volatility? They contracted this coming week. All right, so we just came off of a week where we had a $37 expected move. We smoked through it by 20 points. Now, this coming week, what do we have? Now we're sitting on about a $30 expected move, meaning that the implied volatility actually contracted because the market effectively went up. Now, here's another interesting point to be made. If you look at the last 8 weeks inside of the S&P, 4 out of the last 8 weeks, we broke through expected move, which is, again, yeah, I'm kind of segmenting the last 8 weeks specifically, and I'm kind of parsing out data, and maybe 8 weeks is not enough to draw a conclusion just yet. But 4 out of the last 8 weeks, okay, it's significant to display, if you will, a wild inefficiency inside of the markets in the short term. Markets are getting, if you will, kind of frothy. Now, this could be the upside or the downside because, again, one of the major breaches of the expected move, right, in the last few weeks was effectively to the downside. So markets right now, and specifically the SPX, is doing a horrific job in pricing risk. Think about that for a second, because people talk about how efficient markets are. Well, in the last couple of weeks, they're displaying just, rampant inefficiency. All right, third point to be made over here. Coming later into the week, we had what we call unusual drivers. In fact, if you looked at the markets on Friday, which I'll show you here momentarily, the Dow was relatively flat, okay? And monsters of tech, when I say the monsters of tech, okay, that's our, coalition, if you will, of Apple and Google and Facebook and Amazon and oh my. Anyway, I'll show you that here in a few moments. Those were not the drivers on Friday to the upside. So you had the Dow that was relatively flat. Tech wasn't driving you. So you look to the financials, right? And the financials, where were they on Friday? Absolutely not there. So it's an interesting, again, kind of cyclical rotation. Stocks that have not been driving markets at all of a sudden spring to life and bring the S&Ps up another 15 points. Again, going to be highly unusual, and I'm going to show you that here in a moment. The fourth point that I want to make before we dive into this is, and again, this I'll plead with you here, is get your hedges on. So we see some signs of inefficiencies in the marketplace. By the way, that doesn't necessarily mean like, when I say get your hedges on and there's inefficiency in the marketplace, it doesn't mean get under your desk and duck and cover, right? We are going through right now absolutely this wild surge to the upside. And it is kind of reminiscent, if you will, of what we saw in January of 2018, which again, I'll show you here momentarily inside of the charts. Nevertheless, the opportunity, when I say get your hedges on, it's not because per se I think that the market's going to tank tomorrow. Because volatility right now, and this is the real reason you get hedged, volatility is dirt cheap, okay? Again, markets are doing a terrible job of effectively pricing out that volatility. We're surging beyond what the implied volatility says. Few things in this front. Number one, you definitely do not want to sell options right now because what? We're smoking through what's supposed to be expected. So selling options seems to be out of the question. which tells me one of two things. I either got to get my hedges on or buy volatility here. Okay, those hedges can include risk twist spreads. By the way, a risk twist spread could be used as a hedge, or it could be used as just a wild downside shot. We're going to look at atomic hedges for those of you that have 401k and IRA. Listen, get yourself protected. Lock in what gains that you have right now, or we can even look at what's called the VIX volatility spread. With that, let's get to it. Let's show you some of the charts, some of the option chains, and a few of the opportunities I'm taking advantage of right now. To the charts and trades we go. So let's start off with a look here specifically at the TNX. If you've never heard of the TNX before, it happens to be none other than the 10-year Treasury Index. Now, I know it's quoted here on your screen at 25.01, but what that effectively means, it's approximately 2.5%. So it's 2.5% on the 10-year. I was saying is we're only 2 weeks removed from a yield curve inversion. What's the yield curve inversion? That's this 10-year right here. Okay, that was just crashing to the downside, hitting all the way down to about 2.35%. This 10-year was actually lower than a 3-month. So when the 3-month exceeds the 10-year, like, that's it. That's the sign. That's the sign, wait a couple of months, yada, yada, the recession effectively comes. So, all right, I get it. Okay, the 10-year kind of recovers back to the upside. So we recover back to the upside from this 2.35% all the way back to the 2.5%. So again, with this, the yield curve is no longer effectively inverted. But I'm going to give you another look entirely at the bond market. So the bonds are going to trade inverse to the interest rates. And this is one thing I was talking about extensively, not only in last weekends. I talked about it on Monday. I talked about it Wednesday. What were the expectations? That the bonds would actually sell off and then pop back to the upside. Well, guess what? That pop effectively started. And when I start talking about this, the reason that I'm spending so much time lately on the bonds is, the bonds are influencing the financials. The financials are undoubtedly driving a lot of the S&Ps. So let's give you that relationship again. Bonds, okay? Driving the financials. The financials are actually driving the S&Ps, or at least supporting the S&Ps in driving higher and or lower. So with this, as we actually see the bonds, right, in the last 2 days, they look like they've reversed back to the upside. In fact, again, we have had a full-fledged reversal back to the upside of the ZB. It only finished up 10 ticks. What did that do? It actually said, halt, in terms of the XLF. Now, the XLF, this is the way I'm actually going to depict the financials to you by looking at the XLF. The XLF, well, that's the infamous, if you're into it, the Doji Star. We're trading just right north of 2650, which is, for those of you that haven't tuned in, or a little bit newer here, this is what we've called kind of the Maginot Line, and we've been talking about that for the better part of about 15 months, this level of 2650 inside of the financials. Now, the reason I'm spending so much time on this is you really want to know what's going to go on this next week. I strongly suggest that you watch those financials. One of the things that I'll kind of delineate here in just a few moments is that our financials, if you will, they were not strong at all on Friday, but somehow the S&Ps still surge by 15 points, 0.5%. And again, you're not getting support from the financials. These financials roll over, it will pull down the S&Ps. Now, okay, that is going to be predicated on effectively what these bonds do. If the bonds start to rip again, okay, the yield curve is going to invert once again, and everybody's going to start talking about recession fears. This is kind of like a merry-go-round, okay, of good news versus bad news. And, you kind of, as we go around on this merry-go-round, you're going to hear like Brexit's back, right? And all of a sudden yield curve inversion's back. China trade war is back. And again, we're about halfway around on that merry-go-round. It looks like the bonds ripping back to the upside. That's going to cause some more fears to come out. So for right now, yeah, the S&Ps, they kind of continue to surge to the upside. And we also have a gravity point, okay, just north of where we're currently at. It's 29.11. And I want to just highlight that for a second. We are just shy, again, of a 29.11 gravity point inside of the S&P futures. All right, let's move onward and upward. Let's get to the SPX. So one of the things that I was just mentioning moments ago was the SPX in the video portion the last 8 weeks. Okay, so let's kind of zoom in, for instance, the last 8 weeks here, and I'll just highlight this. All right, there's a breach of the expected move, a breach of the expected move, a breach of the expected move, a breach of the expected move. Now you know why I highlight the breaches of the expected move. That's the last 8 weeks. 4 out of the last 8 weeks, or 50% of the time, we're actually breaching through the expected move. And yet, at the same time that this is going on, they're contracting the volatility. Again, I have to show you this, okay, on the week, because it's fairly shocking to me. And I'm even going to close up the left side bar to make this this point over here. Look at the expected move. Drops down to like under $31. Now, again, why do I care? Why is that unusual? Because this past week, all right, and I just I'll draw this on your screen right here. This past week, that was looking for a $37 move higher or lower. We breach it. So you would think that the S&Ps be like, whoa, we should at least keep the $37 expected move. No. Now they contracted, okay, to about what? Plus or minus $30.80. Think about that one for a second, because it's wild. And again, it actually makes me want to be a net buyer of option premium. And I'm going to reiterate that time and again, on a day-to-day basis, especially an intraday basis, okay, buying options is the way to go. Get long gamma. Why? Simply, it pays. How do I know that? I don't know. Look at the last 4 of the last 8 weeks. You know, you could have just blindly bought options and effectively made money in the SPX. All right. So with that, again, this kind of contraction of volatility kind of continues, but is it really warranted? Well, you know what? Take it with a grain of salt and just think about, okay, the idea that you want to be net long options over here. Moving on. You know, a moment ago, I was talking about unusual drivers inside of Friday's trade. Let me kind of explain what that means. So the SPX, or the S&Ps, as I was saying, they finished up, and I really want to highlight Friday for just a moment. And why am I effectively highlighting Friday? Because it was simply that unusual. So throughout the course of this week, obviously the S&Ps surged to the upside. Friday just kind of iced off the cake over here. The unusual drivers. Okay, let's get down to it. So on these S&Ps, they surged to the upside by the tune of about, what, 0.5%. The Nasdaq outperforms. The Nasdaq is actually up almost 0.7%. The Dow, okay, and I'm looking at Dow futures in this case, they're totally flat. And the Russell also flies to the upside. So, you know, regional, small caps, okay, and I say regionals, that means regional banks, surge to the upside over here. But what gives? And when I say what gives, right, you don't have the XLF taken off to the upside. All right, the XLF is relatively unchanged. Then you have to look at what we term the monsters of tech. And the monsters of tech is a collective. Okay, and what's the collective? It's a symbol that we built, and it's Facebook and Apple and Microsoft and Google and Amazon. Oh my, right? The monsters of tech finished up about 0.3%, but that was pretty much all on the back of Amazon. You know, it's what have you done for me lately? Well, the rest of the monsters of tech, Google even finished down on the day, Facebook down on the day. Netflix is not one of the monsters of tech, but well worth seeing that it was effectively down on the day. So how are markets actually surging to the upside when, and specifically when you start looking at the Nasdaq, this one's a little bit of a head scratcher. So I started looking more detailed into this. And again, what effectively you've got, and by the way, this is the Dow, you can actually switch this, okay, to different public lists. And one of the reasons I'm bringing it up, I'm just going to bring up the Nasdaq 100. Then I'm quickly going to sort by percentage change, right? So I can immediately, okay, differentiate and kind of dissect specifically in the Nasdaq 100. I want to know, okay, inquiring minds want to know what drove the Nasdaq 100 higher. So I just sort by percentage change. As I said, this ain't the usual suspects, all right? And the market caps of most of these, it's a ton, if you will, okay, of smaller market caps. Meanwhile, you have some of the larger market caps, okay, that aren't performing well. And some of the stocks that are actually in this list, okay, you start to look at like, well, what was down on the day? Like Adobe, Google, Netflix, all right? Intel has been an unbelievable performer lately. We're going to talk about that. CSX, a lot of people don't realize that that's actually inside of the Nasdaq 100. It's down. These are good-sized market caps that have been unbelievable performers lately, and they've actually rolled over on a day where the marketplace finished a little bit higher. Unusual? I absolutely think so, and I think you really want to take a look at this as we kind of move forward. Again, the drivers of the marketplace, and I say the drivers of the marketplace, we'll go back to the XLF for a second. You're going to tell me that the XLF didn't drive the marketplace the last 2 weeks? That's what took the S&Ps, okay? And now the XLF is completely stalled out. Now, that's stalled out, okay? Listen, it's right on its inflection point. It is a doji star. It's the indecision candle over here. Again, I think that specifically in the financials, once again, it's the bonds that are going to be the driver over here. Now, with this, okay, and before I go any further, okay, herein lies some trade opportunities. And why some trade opportunities when I talk about like unusual drivers? And again, this kind of like cyclical rotation, if you will, out of, stuff that's been wildly strong. Let me show you one of the stocks that I think that has been wildly strong as an opportunity. We're actually going to cruise over to Cisco, okay? Now, come on, a lot of you probably haven't brought up Cisco. You're like, I haven't looked at that stock in 25 years. That's because it hasn't mattered much since, it's not quite 25 years ago, but, since 98, 99, maybe 2000. So the beginning years of my trading career. Anyway, and again, I'm kind of poking some fun at this because that was Cisco back there. It's about just over 20 years ago. Nevertheless, Cisco right now looks like it's the greatest thing on earth. In fact, in a year-to-date percentage, take a look. You got to talk about this for a second. It's 28% on a year-to-date basis. Did not participate in the last 2 days of the rally. Okay, I would seriously keep an eye on this one. In fact, not only am I keeping an eye on it, simply from a risk-reward perspective. When I say risk-reward perspective, I want to just clarify and quantify this. All right, I like to look at things and say, what's some of the upside potential versus the downside risk? And if I think that I even have an edge in terms of risk-reward, that can be viable enough for me to want to execute into a trade. It's not about, a stock that I want to be a contrarian. This thing has gone straight up. Okay. It's about its ability to continue this ascent versus some of the downside risk. And I know because I've been through this, thousands and thousands of times. I know I may have to wait a while. So in this particular case in Cisco Systems, I'm actually going to use what I term a duration position, a duration stance. What does that effectively mean? It means I'm going to be in this one for a while. Duration, anytime I say duration, in excess of 3 months. So if you like what I'm doing over here, you have to fully recognize that you better be willing to sustain this position, okay, in excess of 3 months, 6 months, a year, okay, to try to get paid on something like this. It's the outperformance. Look, Cisco is up 28%. Let's take a look at the Nasdaq. All right, pull up the Qs. They're up 19%. It's the overperformance, the outperformance, and eventually this thing often comes to fruition. So inside of Cisco, what I'm effectively doing is I am using, an in-the-money put. Okay, in this case, I'm using an in-the-money put as a synthetic short position. Would I go out and outright short the stock? Sure, I could do that. Although this is an IRA and I can't short stock in an IRA. Nevertheless, if I was on a regular taxable account or portfolio margin account, I could absolutely short this stock. But why? Why tie up all that capital? I just go out there, buy a deep in the money put of an 87 delta for around $5. Seems much more reasonable. And in the near term, and again, I'm every instance, and I'm going to be rolling this out. Like, I don't want you to think, well, you only did for 76 days. I'm going to be rolling this out, okay? Everything in me says, all right, we're probably going to have to sustain this for a period of time. Nevertheless, that's the kind of risk reward that I look for. And, the fact of the matter is, at a time where the marketplace is surging higher, this is where people don't like to step in and get short. They're going to be like, what are you, crazy? Okay, listen, there's every sign on the screen right now that there's going to be a cyclical rotation out of stuff like this, okay? I'll take it. And again, opportunity is often where people don't want to be. And you got to think about that as a trader. Last, but definitely not least in this weekend's update, you got to talk about your hedges. Get your hedges on, okay? Because right now, it's the cheapest in terms of hedging that we've seen in quite some time. So as the spiders, and I'll use the spiders in this case, surge to the upside. The spiders are up about 15% on a year-to-date basis. Remember, the S&P typical year only turns out about 8%. That doesn't mean that it can't go higher from here. I mean, we could absolutely burst to all-time highs, okay? But if you're going to try to hedge or you're going to try to take a downside shot, okay, is it reasonable to wait? The problem with going out and hedging or taking these downside shots is Everybody wants to see a marketplace that starts to turn. Like this, people are like, oh, when it starts to turn, they wait for like smoke signals and the marketplace to wave red flags at them. Listen, you're never going to get that. And the moment that you do get that, like, when the market does turn, the volatility is going to fly through the roof, right? Markets are going to be ultra sensitive. Volatility is going to fly through the roof. What are you going to be left with? Nothing. You hedge, okay? You hedge when we are surging to the upside. And when I talk about hedges, I'm talking about the risk twist spread. I'm talking about the atomic hedge. I'm talking about VIX volatility spreads. I'm over here in the spiders just showing you this because even as you go out in time, right, and highlight, I could do a better job of highlighting that even as you go out in time, right? Even all the way out here, what, some 167 days, and I'm not saying that you need to go this far out, but it's only 16% implied volatility. So for those of you that do understand a little bit about the risk twist spread, probably out in this area, you're buying a 15% implied volatility, and for me, that ain't bad. It ain't bad at all. Okay, or an atomic hedge. An atomic hedge might be from anywhere from like 30 days on up to about 40, even these 48 days. And in here, you're actually tinkering with only about a 13.5 volatility. I don't know about you, but that looks pretty effective to get myself hedged in a marketplace, again, that's kind of bucking, if you will, all the trends. And the last thing, again, I'll kind of leave you with is what we term this kind of disconnect, all right? It's earnings season is coming. If you're not aware, when I say earnings season is coming, just take a look. Like one of some of the big earnings that typically come out first, it's the banks. All right, we're we're 10 days removed from like Bank of America. All right, even before that, we're gonna get J.P. Morgan. Woo! So J.P. Morgan, here we go. All right, on the 12th. Okay, when is that? It's later this week. So you're actually going to get financials that are going to start to produce earnings later this week, Friday morning. Okay, you're going to start to get some news breaking. What better time? Listen, if earnings fall flat on their face, what better time to get yourself hedged? And again, if there is this massive disconnect between what the S&Ps are doing, okay, and what's really going on, well, what's really going on is it's going to start to come out in the earnings. The other thing you've got facing you, again, as I said, it's like this merry-go-round, and the bad news comes around, every couple of weeks. You have everything from Brexit to a yield curve inversion to possible earnings announcements. I mean, I could probably go on for a half an hour on all the different news that could possibly break. And the marketplace just keeps right on chugging along. The other aspect, and again, I'm just going to leave you with one final thought over here. I got a great email this week, and it said, hey, don't fight the Fed. And I said, fight the Fed? Not fighting the Fed right now. The Fed, first of all, isn't raising interest rates. They're not actually doing anything with interest rates. They said that for 2019. Meanwhile, the Fed, okay, is still, okay, doing QT, which is quantitative tightening. Right now, if I'm short this marketplace, technically I'm actually with the Fed. I'm with them. The Fed has actually been, again, very stringent and will remain stringent for the better part of 2019. As of right now, again, the markets have anticipation that the Fed may cut. That may never come to fruition. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.